This panel concerns monetary and fiscal policy around the world. We talked this morning and this afternoon about the consequences of the crisis for the financial system and for housing. The crisis took an enormous toll on workers and created hugely high unemployment. The economy fell into recession at the end of in December 2007. So even before Lehman, the unemployment rate was rising. In 2008, it ended the year at 7.3%. But the job market really went into free fall after Lehman, with job losses at a monthly pace over 500,000. And eventually, the unemployment rate rose to 10%. And the tools that were then brought into play to address that were monetary and fiscal policy, and that's what we're going to discuss in this crisis, to look at the response in the United States and also abroad and in our trade partners. We'll talk about how aggressively and effectively tools were used to address the contraction that was taking place and what some of the constraints were. Let me introduce the members of this panel. Jason Furman was Deputy Director of the NEC in 2009 and later became Chair of the Council of Economic Advisors in the White House. Don Cohn is a Fed lifer who at that point served as Vice Chair of the Fed through 2010. Let's see, Brian Sack, I believe it was 2009, became head of the Open Markets Desk in New York, where he served until 2012. And Ted Truman is also another Fed lifer who had earlier left the Fed but was brought back during 2009 as a counselor to the Treasury Secretary to work on the international coordination side. So we're going to start off with presentation first from Jason on fiscal policy and then from Don on monetary policy. We'll bring in then the rest of the panel.
Great. Well, thanks so much. And I'm glad that on this panel we're going to get at least 20% of the people up here do fiscal policy. So inject a little bit into this room with financial and talk about some of what I talk about in the paper. The first part of the paper is just documenting what happened and when it happened. And it starts with the first stimulus that was negotiated by Secretary Paulson, signed into law in January 2008, which makes it remarkably timely. Rarely in our history do you have one that proximate to when the date of a recession was. It was done when the Fed funds rate was still 4.25%, so there was a lot of room for monetary policy. The way I think about the rationale, Hank may have a different thought, is that fiscal policy can actually be faster. Within months, the first checks or electronic payments went out to people a little bit after checks did, so it can fill in some of the gap before the monetary policy, the rate cuts were going to affect the economy. And second, that we're never quite sure about what instrument works, and with instrument uncertainty, diversifying your approach makes sense. Of course, the part of the fiscal response that got the most attention was the second part, which was the Recovery Act, signed into law by President Obama on February 17th, 2009. By then, it was clear that we needed something much more substantial. We wanted something that was as fast as possible, so we did things on the tax side in a substantial way, with the reduced withholding going into effect by April 2009. But also, we weren't too worried about things being sustained, and so there were things on the infrastructure and investment side that played out over a longer period of time. A lot of people think that after this, there was some pivot and fiscal stimulus ended. What there was after this were a lot more fiscal stimulus proposals and a number of actions, but the actions were much more opportunistic, under the radar, whenever you had a chance to. There'd be an FAA bill, a defense reauthorization bill, and we'd add money for teachers. We'd add money for state fiscal relief for FMAP. We took things like the Making Work Pay tax credit, which was $60 billion a year, and replaced it with a payroll tax cut that was $110 billion a year. So when you add that next phase this is about a dozen different laws, you get those gray lines there, and you get a discretionary stimulus that over a 5-year period of time averaged 2% of GDP, which is the largest discretionary fiscal stimulus we've done for countercyclical purposes. And then you get the automatic stabilizers on top of that, bringing the total to 3.4% of GDP. Now, you'll see it maxes out in 2010. By 2011, the economy was still in a lot of trouble, but the fiscal support was declining. If you quantify the impact of this on the economy, the picture there spreads out a little bit more than this picture does, because a lot of things operate with a lag. In the Furbis model, for example, tax cuts matter just as much at T+2 as they do at T+1 as they do at the time you do them. And so there the maximum impact was 3.4% of GDP. Towards the end of 2010, it stayed at about that level, but the impact on the level of output is falling starting in 2012, which means growth rates are lower than they otherwise would have been starting in that year. A lot of what we cared about wasn't just the GDP, but how it affected people. And so we designed a lot of things like expanded food stamps, expanded unemployment insurance, tax credits for families. And when you combine those with the existing safety net and the existing automatic stabilizers, you see something remarkable that I think is just very underappreciated, which is that market incomes fell across the board by about 10%, a little bit worse at the bottom because people lost jobs, and at the top because they lost their wealth. You then look at what happens after taxes and transfers, after you get the tax cuts, after you get food stamps, UI, whatever it is, and you see a radically different picture. You actually see an increase for the bottom quintile. You see most of the damage contained for the second through fourth, and you see relatively little change for the highest quintile. These are straight out of the CBO numbers. You can do it a lot of different ways. You can tell somewhat different stories, but you get something that looks an awful lot like this. You'll need to read the paper to find out about how we considered sending everyone in this room a debit card, giving you all a temporary tax holiday, and then something we publicly proposed but didn't get done, a new jobs tax credit. What I'll end on is the 6 lessons that I derived from this experience. The first is fiscal stimulus can be very effective, especially when you're at the zero lower bound. There's a ton of research that's been done in the last decade, some of it off the Recovery Act, and it finds, if anything, higher multipliers than we previously thought. That's number one. Number two, be very careful about state and local moving in the opposite direction from what you're trying to do federally. State and local cutbacks took 0.6% off the annualized growth rate compared to the pattern of their spending in previous recessions. Third, the fiscal system can tire of stimulus early. One of the political judgments we made was if things are worse than we expect, we can always get more. We didn't get nearly as much as we would have liked. And so building in more triggers and automatic stabilizers up front rather than relying on the gravity of the situation to persuade people to come back would be helpful next time. Fourth, having program integrity, avoiding the types of scandals that we largely, almost entirely avoided, is important. Fifth, that there's increased body of evidence that tax cuts may actually be more effective in terms of multipliers than spending. I'd want to see more data before I was 100% sure, but I certainly think that more than I thought a decade ago. The evidence on temporary business tax incentives like bonus depreciation is particularly strong, as it is for low-income tax cuts. And then finally, most of our stimulus was focused on maximizing GDP. You can also take steps that maximize the number of jobs per unit of GDP. So something like a new jobs tax credit, our estimate was it would cost about $20,000 per new job, as opposed to more than $100,000 per new job from just trying to raise GDP, which is what most of our approaches did. So hopefully next time we can do more, even if we can't control the downturn, to control the impact it has on labor markets. Thank you.
So I'll cover the monetary policy. This work is jointly with Brian, who's sitting next to me and clean up any messes I leave behind here. So I think as Brian and I looked at the monetary policy process through the crisis, three themes struck us, and they're quite related to themes we've heard before today. One was the difficulty of forecasting not only what would happen to the financial markets, but even when you knew what was going to happen to the financial markets, what would the effects be on the economy? The second one was the more faster one that's come up in several themes, how even given the forecasts, with the Federal Reserve and the FOMC was incredibly innovative and aggressive in its monetary policy, both interest rates and purchases and forward guidance. But given the forecast, it might not, with 2020 hindsight, you want to ask, could it have been more aggressive? Could it have done more, and why didn't it do more sooner? And then the final one is the importance of communication. So let's start with the forecast. We were constantly under-predicting not only what would happen to the difficulties in financial markets, but the sensitivity to the economy of what was happening in financial markets. It's not surprising. None of us had had any experience with anything like this. Ben had the advantage of having studied the Depression, so he was way ahead of the rest of us. But in general, we hadn't lived through this kind of thing. And our models and our mindset, I think, was not prepared for what we were what we were going through. The models themselves had a few key financial variables: interest rates, asset prices. There was no complexity, no financial frictions, no availability constraints. And I think those models reflected the way we as economists thought about the financial markets and the transmission of financial information to the economy. They are linear relationships extrapolated from a period, particularly the Great Moderation, that which everything was very smooth. So I think the lessons from this are ones that happily the FOMC, with Ben and Janet and Nellie and Andreas, have learned. That is, you have got to, it's not only for financial stability, lender of last resort stuff, but for monetary policy, you've got to have a wide focus on financial markets. You've got to be open to the potential that things will be nonlinear, that they will happen suddenly, that there will be channels of effects like credit availability onto the economy that you haven't anticipated before. You've got to probe for tail events and what their effects might be. You've got to be ready to throw out your models when things happen that aren't incorporated in those models. And I think we see in the minutes every quarter there's a briefing of the FOMC on financial developments. It's very wide. It's not just focused on banks. It's the whole thing. So the important lesson here is don't back away. Keep working on trying to understand the financial system. On the policy response, thinking about two things: the federal funds rate from August of 2007 until August of 2008, we had cut the funds rate very sharply, particularly in January, March and April of 2008. But we were just keeping up with the effects of the forecast reductions. So the forecast that the FOMC and the staff had through this period had the unemployment rate staying around the full employment and inflation staying around 2%, but there was no risk management. We weren't getting ahead of the thing. We were just kind of keeping pace with the deteriorating situation to keep our forecast in line with the FOMC's dual mandate. And I think the lessons, the question is why not? Why didn't we do more? In the case of the federal funds rate, part of the problem was the incoming data. So inflation was rising, and the economy was not really going into a deep recession. It was soft, but not going to a deep recession. And the lesson for us is you've got is risk management. So you're in a financial problem, the risk to the economy are to the downside, and the risk to not doing enough are to the downside, especially if you're near the zero lower bound or the effective lower bound. So I think for the next FOMC that's in this situation, taking a little bit of insurance out or a lot of insurance, even as you're cutting the funds rate, being aggressive in that regard is very important. And I think, given the experience in Europe, thinking about what the effective lower bound is, whether you couldn't go into negative territory, they should also be doing that. On QE, on LSAPs, so large-scale asset purchases, the Fed, we started that in December of 08 and expanded it greatly in March of 09. We didn't think that the amount of purchases we were doing would be enough to put the economy back at full employment and keep inflation at 2%. So we were behind the curve there. And we were behind the curve because we saw the costs and benefits of additional large-scale asset purchases as approximately balanced. And I think the lesson that Brian and I would draw from what we've learned since is that the costs and benefits weren't balanced, that there were definite benefits, that large-scale asset purchases, QE, can lower interest rates even in well-functioning markets. I think the evidence is pretty convincing on that. It's somewhat disputable, but I think the balance of evidence is that there are benefits to these purchases. And the costs were perhaps less than we had feared, in part because of actions the FOMC had taken. So, for example, there was a lot of noise outside the Federal Reserve about inflation potential. I think inside the Fed, we weren't very worried about the monetary base causing inflation, but that certainly was an invalid, there was no cost, no inflation cost. Inflation was too low, not too high, and it hasn't come up. So that was not worried about. I think exit preoccupied us a lot. Given this large balance sheet, could we raise interest rates when we, the FOMC, needed to do it, wanted to do it? Would it impede our ability to tighten policy? I think the work of the FOMC, the New York Fed, to develop tools to absorb reserves or to raise interest rates, the interest on excess reserves that the Congress has given the Federal Reserve. We've seen over the last couple of years, the Fed has been able to raise rates even though the balance sheet is very large. So I think a number of the costs that preoccupied the FOMC turned out to be less serious than people thought at the time. So I think a lesson we draw from this also is you can be more aggressive. Given what we know now, you could be a bit more aggressive in the next thing. And the final point is about communications. Two aspects here. One is forward guidance. It's really, really important that the public and the markets understand that you're going to keep interest rates low for a long time till the recovery is well established and your targets are in view. And conveying this, the FOMC's language changed over time about how to convey this. There were vague words used, there were dates used, there were thresholds used. Some combination of all that. I think the threshold stuff was a good invention, but it's so important for the effectiveness of monetary policy that people understand that the reaction function of the Open Market Committee has changed in a situation like this, and they're not going to get an increase in interest rates as soon as the economy begins to pick up. And the second part of communication, I think it's one that affects all these programs, is I don't think that's a very broad we, including almost everybody in this room, really did as good a job as we could have explaining to the public of what we were doing and why we were doing it. And I think Ben, in that 60 Minutes program, really was an important innovation from the Fed's perspective, reaching out to a broader audience. I think we should have done more of it. All of us should have done more of it, trying to explain why what we were doing was for the benefit of the economy, not for the benefit of the banks or the bankers. And that's, I think, a lesson for all the programs we've examined today. Thank you.
Thank you. I'd like to come back and drill down a little bit more on fiscal and monetary policy, but before we do that, I'd like to ask Ted to talk a little bit about globally, how would you evaluate the fiscal and monetary policy response? And to what extent do you think coordination among countries on policies was effective, and was it something you saw as necessary?
Right. That's a big set of questions, Janet. I should say in advance that among the lieutenants, I was a retired lieutenant, and fortunately or unfortunately, Tim's secretary had my phone number, so I went to work with him again in March of 2009. So I'm a bit of an interloper in terms of the veterans of this experience. My sense is that, but I studied it during the period and in connection with this very interesting project. My sense is that we didn't do the global policy community did not do a terrific job in sort of achieving early on a shared diagnosis of what's going on, and therefore having a shared diagnosis of how collectively we should act. On the monetary policy side, leaving aside whether I still say we for the Federal Reserve, should have done more sooner. And I think Don has laid out the case where you could certainly say we could have done more sooner in retrospect if we knew everything we know now. But the other central banks, major central banks, were much slower. In general, and some of them took quite a long time for that, partly because of philosophical reasons. One important question, probably off your topic to Janet, but is, as was already referred to, inflation was pretty high in some countries, and for those central banks who had, at that time, had inflation targets, which were headline inflation targets, they were worried about pressing up against those inflation targets, and that led them to delay. So it took, it seems to me, really starting in August of 2007 until the fall of 2008 before Ben and Tim and others got the central banks on the same, roughly on the same page. It seems to me it was even more complicated on the fiscal side, as I read it. Actually, we say in our paper, which you guys haven't seen yet, but what we say in our paper is that it actually was the International Monetary Fund who came out with the initial idea in November, early December, about a coordinated fiscal expansion. The administration sort of picked up on that. That became a huge debate, as not just in this country, but a huge debate about sort of what counted as expansion and what's the role of automatic stabilizers and so forth and so on. And it threatened, I think, to derail the whole process. So the administration pulled back a bit on how forcefully they wanted, but they ended up getting, and certainly Gordon Brown was able to put in his London communique a fairly inflated number about how big a fiscal expansion was. So by that time, but that was talking about April 2009, you had the authorities mostly all agreeing. I should say that there was, just to be fair, there was language in that pointing in that direction in the communique that came out of the Washington G20 summit, and the Washington G20 summit, in a very important way, laid the predicates down for what was subsequently done. So you can't think about those two coordination exercises as separately. I think it is important. I mean, as other people have done, maybe I can say this. Coming back to the Treasury Department in March of 2009, I was impressed by what was essentially on the international side a core of of dedicated public servants, since there wasn't anybody else of a political appointee at that point. And the work that they put into and the dedication that they showed was, and the imagination they had already showed in working on the Washington summit and the hard work that they did on the London summit was something that was very impressive, and to this day warms the cockles of my heart.
Thank you. Brian, so let me come back and ask you a little bit about monetary policy and start with forward guidance. And I wonder, Don talked a little bit about evolving forms of forward guidance, but I wonder if you'd reflect a little bit about how forward guidance was used and what lessons you see coming out of that. Calendar-based forward guidance versus thresholds, were they effective? Also, it's sometimes said that the Fed's forward guidance was Delphic, meant to be a forecast and not in any way a commitment. But there's a good deal of literature that suggests that effective forward guidance needs to be Odyssean or to involve a commitment. And I wonder how you see that issue, or do you think there was any commitment element to the Fed's forward guidance?
Sure. So, as Don said, I think the forward guidance worked quite well. I remember, well, first there was the qualitative guidance that came in December '08 and March 2009. But later on, when the FOMC moved to calendar-based guidance and eventually to threshold guidance, I remember thinking about this in real time when the first set of calendar guidance was proposed. And, market expectations were pretty pushed out at that time. And so the principal policymakers asked the staff, how effective would this be? And I think the answer was basically, well, it'll be effective, but, the market pretty much understands that you're not tightening for a while. And at least from my perspective, it actually had a bigger effect than I realized. And it had a bigger effect, I think, because even though the mode forecast was tightening would be relatively far off, it shaved off a meaningful part of the tail about an earlier liftoff. So as we show in the paper, the different forms of guidance really seem to affect people's perception, not just of the timing of when rates might go up, but also of the reason for why rates might go up. So this was not that the forward guidance conveyed a degree of pessimism about the economy and people just marked down their economic outlook, which was one of the major concerns. What we show in the paper was the markets actually, and the markets and the public actually took this guidance as suggesting a more aggressive policy approach by the FOMC. And by doing that, by shifting the perceived reaction function, I think that's how you get a lot more stimulus into the economy as opposed to conveying a pessimistic message. So expectations shifted quite a bit. I think that was effective. And as I said, it was about the reaction function. Now, it was not, so my impression, and the policymakers could actually answer this better than I could, but it did not go to Odyssean guidance. This was not an unconditional commitment to follow this path no matter what. This was not strongly tying the hands of the committee to follow that path. But I think by saying what the projection was, it likely raised the threshold of deviating from that path to some degree, and it likely gave the markets just clearer information about the policy intentions of the committee. And I think both of those things were effective at making financial conditions more accommodative.
Don, you talked about asset purchases, and I guess the Fed purchased both Treasury securities and mortgage-backed securities, some debt, thanks, Ed. Also some debt of the Federal Home Loan Banks. The purchases of mortgage-backed securities were controversial. There were members of the FOMC and of the public, members of Congress, who felt that this was credit allocation and the Fed should not have been involved in buying mortgage-backed securities. the Fed is essentially now committed to go back eventually to a Treasury-only portfolio. So, in the one hand, I'm interested in your comments on whether or not you think it was important to be able to buy MBS. The other related question I guess I would ask is, if you look around the world at Japan or at the European Central Bank, and you see that they're also engaged in asset purchases, and they're buying a much larger range of securities, including private securities and even equities in the Japanese case. Do you think it would be useful in fighting a future crisis if there was a greater ability to buy a broader range of assets?
So I do think the purchase of MBS and agency securities, that purchase was very important at the time. So despite the fact that the agencies were in conservatorship and the implicit guarantee had been made explicit, those markets were disrupted. And the spreads of MBS guaranteed by the taxpayer, MBS over treasuries, had risen quite a bit. We saw that on one of the charts that someone, maybe in the initial presentation, had risen quite a bit. And the same was true to some extent for the agency debt. And here you had a crisis that was centered in and originated in the mortgage market, and it seemed really important to get that market reopened and re-going and get mortgage rates down. That would help the help households and the housing sector. So that initial those initial purchases of MBS had a huge effect on mortgage rates. I think 0.5 point or more on mortgage rates almost immediately. And obviously that wasn't enough to stop the crash, but it must have helped to some extent and got those markets going again. I think there was a degree of discomfort on the FOMC having to do with getting the FOMC involved, even indirectly, even though there was no credit risk because it was government guaranteed in credit allocation. There was an accord that the Treasury and the Fed signed in the spring, I guess, of '09, which talked about the roles of each institution, and one of the pieces of that was to acknowledge that credit allocation was in the fiscal authorities, not in the monetary authorities. But I think in this case, there was an overwhelming case for intervention in that particular market. Now, should the Federal Reserve have more tools in corporate and Japan, even equity prices? I think that's very, very tricky and difficult. We heard about it some already today, that in acting as lender of last resort, the Federal Reserve had at least some residual credit risk on its balance sheet. I think getting more deeply involved in more credit risk and more allocation would push us further and further into the fiscal space. I can see that it might be useful in some respects, but I'd be very concerned about going there without a lot of safeguards, including some understanding, explicit understanding through legislation about who would bear the loss, how the decisions would be made, the relative roles of the Federal Reserve and the Treasury in this. I think it'd be very, very tricky. And I think we can have most of our effect in decently functioning markets. I think you can have a lot of effect buying Treasury securities and having that feed through to other rates. And I think the academic literature is that our purchases of Treasury securities did feed through in somewhat attenuated form into corporate bonds and certainly helped the equity market on the way up. So that's a much better way to go about it than direct purchases.
Let me pose a question from the audience. We've now had a long period of low interest rates. The question is, are you worried that the long period of low rates are creating new bubbles, tech stocks, commercial real estate, bonds? So whoever would like to take a stab at that.
I'll start. I think you always have to be a little concerned about the financial stability implications of promising to keep rates low for long, and people with various portfolio preferences reaching for yield, as they say, and taking risks that may not be adequately compensated for. But I think so far, yes, there are little parts of the market that look like they may be a little overextended. People often cite commercial real estate, leverage loans. These are you can find this in the Federal Reserve's monetary policy, semi-annual monetary policy reports citing these things. I think at least to date, the financial stability risks seem to be contained, and I think the way to address them is through regulatory and prudential tools. So I think ideally we'd have financial tools to address financial stability and tools to address economic and price stability, sort of a Tinbergian world, two goals, two sets of tools. You could target the one that's most effective. Now, that doesn't mean, as Jeremy Stein has pointed out, there might be some times when the regulatory tools aren't effective because the risks are outside the regulated entities. But I think, and then you would have to use monetary policy, but I think certainly a first resort is using monetary policy to get the unemployment rate and inflation where you want it, and regulatory policy to address the financial stability risks.
Let me ask another question about. Sorry. Let me ask another question about spillovers. One of the complaints about U.S. monetary policy during this period, and particularly our asset purchases, was that they had adverse spillovers to other countries, particularly emerging markets, that complained about it. And maybe Ted or anyone else who'd like to take this, I wonder if you think that's a valid complaint, and if so, how the Fed should address that.
Well, I think that's a two-part question. It certainly is the case that in terms of the global economy, if we get our policies right, especially even after having gotten our policies wrong, we work hard to get our policies right, it's better, the world economy is better off. We may have, I apologize for saying we, because it wasn't I. We may have failed a little bit in making that message. I think, and this is more of an academic comment than, I guess, than a policy comment. I think it's well established with the modeling that I've seen since the crisis that things like the large-scale asset purchases and so forth and so on, like any other monetary policy action, which tends to maybe on the initiative push down an exchange rate, doesn't always happen, by the way, is offset by the fact that it also stimulates real demand. And so the net effect on the net exports in the current account is likely to be close to zero. That message, I think, did not come through as clearly as it might have been. There's this complicated question, which I think we don't really have, international economists don't really have a good answer to, that to the extent that we were exporting inflation, if you want to put it that way, credit easing, that may have had adverse effects on some economies, which we don't understand. My answer to that is always, especially in the first round, right? The world economy needed it. And in general, it depends on what country you're in and how closely you're tied to the United States about whether expansionary policy in the United States, whether monetary or fiscal, is good for your country or bad for your country. So, but I think that was an issue at a minimum that was not well understood and articulated around the world. Maybe we can blame the International Monetary Fund too for that. But I think it was not well understood.
Thank you. Question for Jason from the audience. Fiscal policy was helpful, but aren't you worried about today's high and climbing debt to GDP ratio?
I am worried about it. I should say I'm worried about a lot of things in the economy, and I'm not sure where this one falls on my list. I'm not, when it comes to the next recession, and we're going to have another recession, I'm far more worried that it's going to cause a political problem that will lead us to do inadequate stimulus than I think it will economically get in the way of stimulus. I think the economic evidence is increasingly a whole set of papers that stimulus is very powerful, especially when you're at the zero lower bound, that it may even reduce the debt to GDP ratio by raising the denominator GDP more than it raises the numerator debt in those particular economic circumstances. Auerbach and Gorochenko had a paper at Jackson Hole last summer that found no evidence that fiscal policy was less effective at high debt. In fact, if anything, more so. So I think if we're going into another recession, basically no matter what our debt to GDP ratio is, my economic message is we can't afford not to do stimulus. I'm worried it'll get in the way of that message politically.
A final question, Jason, for you from the audience. Your fifth point was that tax cuts could be more effective than direct injections of money into the economy. In light of that, how do you evaluate the Trump tax cuts? Would these be the right or wrong type of tax for stimulating the economy?
Right. I don't think the biggest problem in the U.S. economy right now is inadequate demand. I think we have a problem on the supply side. I think that's the way the tax cuts were conceived, as encouraging more investment being an ingredient of productivity growth. I did an analysis for the Brookings papers with Robert Barrow, and we found very small increases in investment would result from it, relatively small increases in GDP, in part because the tax system already had lower marginal rates than appeared to be the case, in part because in some senses they're higher under this than you otherwise would have been. But I certainly don't think we need the fiscal stimulus in 2018, and even less so, the tax cut has a fiscal stimulus in 2019, 2020, 2021, et cetera. So my comment was a comment about, counter-cyclical tools. Our textbooks always said the spending multipliers had a multiplier of 1 over 1 minus t, which was larger than the tax multiplier, t over 1 minus t. The empirical evidence seems to be finding that the tax multipliers may be larger. And so when you're designing a counter-cyclical package, when your problem is inadequate demand and no monetary policy, the taxes may have a bigger role than we had previously appreciated.
Great. Well, thanks. Please join me in thanking our panelists.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.